Now, in the room and on the alert service, I have a couple of rules that we trade by. First thing we trade is, we say trade the best, skip the rest. This is important. We're only looking for the very highest probability trade setups to take. We're not trading mediocre trades, because you can just, lose a little, win a little, lose a little, win a little, lose a little. We're looking for only the very best trades. Everything else we're going to skip. And our objective is, this is important, our objective is not to make trades. Our objective is to make money. A lot of traders think that since they're a trader, they've got to be making trades all the time. I have to have some sort of a trade on. It's not true. Our objective, again, is not to make trades. It's to make money, and we do that by trading the very best setups. Okay? Now, as a profitable trader, a retail trader, we need an edge. We need an edge over the other retail traders. We have several. Our edges, the first thing is what's called the right line compass system. This is the system I use that I'll show you that lets us know if the institutions are in a trade or if they're not. This is really critical, because I don't want to be in any trades if the institutions aren't in there. As I said, if you're trading against retail traders only, it's just going to be chop and chaos. You're just not going to have a consistent win rate with that. Then the second one, and this is really important as well, we trade what's called relative strength and relative weakness. Relative strength and relative weakness is not RSI. Relative strength is, how is the stock that you're looking at, or the ETF you're looking at, how is it trading in relationship to the SPY, the S&P 500, or the triple Qs, the NASDAQ. So we compare the stock to the Qs or the SPY, and if the SPY is going sideways or down and your stock's consistently going up, that's relative strength, and vice versa. This is very important, because this also gives you a very good indication that with the compass system and then relative strength or relative weakness, this gives you your likelihood of the institutions being in there extremely high. And third thing is, we want to trade with the market trend, if there is a market trend. If we're trading on a day basis, we want the market to be trending up or trending down, and we want to follow that direction. Now, if there is no direction in the market, which a lot of days there aren't, it's just chop, then we're going to be focusing on the individual stocks and trading in the direction of that particular stock. And the last thing we try to follow and try to follow closely is to buy at support and sell at resistance. Now, this sounds really simple, but what happens is, a lot of times when a stock opens in the morning and it starts shooting up, stacking green candle after green candle after green candle, people get FOMO. They get fear of missing out. They come running into the trade and grab it, and a lot of times it's right at the high, and then it turns around and reverses. Very important to wait for the stock that's moving up to come back to a support level, and then bounce off of that support level, find confirmation that it's reversed back into the original trend, and then get in. Then you're getting in at a nice low level where you have much less likelihood of a big loss. And sell at resistance, same thing. If you're in the trade and it's getting up to a resistance level, you want to take profits. And if you're going short, if a stock is going down and it bounces back up to the resistance level, turns around and heads back down again, this is where you want to get into the trade. So this gets us in at the best prices and limits our losses on any trades that we take. Okay, now I'm going to talk about the compass system. This is the system I use that lets me know whether institutions are in the trade or not. And it identifies the highest probability trade setups and allows us to sidestep trades that might look good on paper, but don't have institutions in them. We don't want to be in those. And it does this again by identifying when institutions are driving and moving, when they are not. It's analyzing really complex data to come up with the information, but then it displays them. In this particular case, it's on the ThinkorSwim platform that I use this. It displays them in easily identifiable visual formats, so you can tell just by looking at the compass system whether the institutions are in there or not. And the fact that it's done in a visual format, it uses colors, it makes it possible for even new traders to find high probability trade setups and skip low probability trade setups. So that's a big edge for us. So again, we're getting an edge over the retail traders. We know who and what our institutional trade is. When the individuals traded, our individual traders' edge is what our edge is. We only take trades that are being driven by institutions. It's really important. Trading stocks that have relative strength or relative weakness, as I just mentioned, versus the SPYs of the Q, and trading in the direction of the overall market. So those are our edges that we have over other retail traders. And believe me, 99% of retail traders don't know this, and they certainly don't have the compass system, so they don't know if the institutions are in there or not. And how does it give us an edge? Well, our trades are going to be supported by institutional buying and selling. We get into a trade, we can be confident the institutions are in there at the same time. So if they're pushing it up, we're going to ride up with them. If they're pushing it down, we're going to ride it down with them. Again, the stocks will be outperforming the S&P 500. This means once the market levels off or turns against us, that stock is going to outperform what the SPY does. So if it turns against us, it's not going to go down as fast as the SPY goes down if we're in a long position. And again, we want to take stocks that are moving in the direction of the overall market if we have an overall market trend. I mean, the market's very bullish right now on the daily chart, so most of the trades are going to be lined up bullishly. But on choppy days, you can take intraday shorts and plan on being out by the end of the day if the stock lines up that way. Okay, so that's how we get an edge over retail traders. And again, this is very important because this is how we make money, by beating other retail traders. Okay, so this is kind of the what I call my trade setup funnel, and this is how we find high probability trade setups. It's basically it's kind of a checklist, but I just call it a funnel. This is very important. Obviously, I want the daily chart to be bullish if I'm going to trade a stock long. If I'm going into a stock long on a 5-minute chart, looks good, it looks bullish. I only want to get in if the daily chart is also bullish. I don't want to have a bearish daily chart and be trying to trade the stock long, because if it turns against you during the day, you're not going to be able to stay in. You're not going to be able to hold it overnight. So it gives you a much bigger likelihood of being successful, because you can basically let the stock breathe a little bit and move back and forth. As long as it stays bullish, you can stay in it. Again, we want to trade with the trend, both the stock trend and the market trend. So if the market is bullish that day and the stock is bullish that day, those are the trades we want to take. Now then, when we know that, we got to look at the compass indicators. If the compass indicators tell us that the institutions are buying the stock or selling the stock, then we can take the trade. If the compass indicator is telling us that there isn't any direction in the stock being driven by institutions, then we're not going to trade it. We don't want to be in there when the institutions aren't in there again. As I said before, if it's retail traders that are only moving the stock, it ends up chopping chaos, and you're going to likely take a loss, and it's just not going to give you the likely high probability results that you want. Again, we also trade against relative strength and relative weakness. So all of these things are met. Does the stock also have relative strength for a long or relative weakness for a short against the S&P 500? If it does, are we near a support or resistance level? If it is, then that stock drops out the bottom here. It becomes a high probability trade setups, and we can look at some more technical analysis to see if it's one we want to take. Because several times you'll get quite a few of these will come out of the bottom, and it looks good. But so this is just a visual of basically what my thought process is when I go through looking for trades to take. And again, it's called the funnel setup. So again, here it is written out in the funnel method for highest probability trade setups. Again, identify the market trend for the day. And sometimes you can't find this. Sometimes there isn't any trend, and usually it takes at least 45 minutes of market action before you can come up with any kind of a trade direction. This is really important. The market drives about 75 to 80% of the stock's movement, all the stocks in the market. So if you've got a trending day to the upside, then most of the stocks are going to trend to the upside that day. So it's important to identify that, because you want that wind on your back when you're taking a trade, and that wind in your back is the market. So that's important to identify that. The stock to be traded should have a daily and 5-minute chart aligned, as I just said in the funnel setup. This is, again, really, really important. And then the compass indicators must align in the direction of the trade. So this is really key, because if one of these is not true, you should not be in the trade. And I'm not going to be in any trades that isn't true at the time I take the trade. Again, the stock should have relative strength and relative weakness to the SPY. On the 5-minute chart, if you're trading, you like the daily chart, it looks good, looks like a nice bullish chart trade. You want to, on the 5-minute chart, the stock should be above the VWAP, the volume weighted average price. That's an indicator that you can get on any particular any platform, and it's very important that you don't want to be trading a stock long while it's still below the VWAP on a 5-minute chart. Wait for it to get to the VWAP and get above it. The VWAP is actually a good support resistance level. And if you're going to go short, you want the stock price below the VWAP to go short. Okay, this is a key element here. Again, enter the trade near confirmed support for longs and confirmed resistance for short. And when you're looking at the daily chart, when you're looking at your trade and trying to figure out if I should take this trade, you want to make sure there's no nearby support or resistance in the daily chart that's going to limit your profit target. In other words, if you're in a trade and it's got 10 cents to the 200-day moving average on the daily chart, you don't want to take it. You've got the resistance is way too close. You don't have a good risk reward because the upside potential versus the downside risk is skewed against you. And the key thing here, and we talk about this every day in the room, is to have patience. Really important to have patience, because a lot of times you've got to wait. I mean, a couple of days this week, we didn't take any trades. There was no setups that were high probability trade setups. So, you get a gap up in the market and then it just chops, or a gap down in the market and then it just chops. There's no trend. So it's very difficult to find the highest probability trade setups when you don't have a market working in your favor. There are some, of course, but it's less likely. So it's important to just wait. Basically, what I do is I just flip through charts all day, looking for trades that may be good if the market starts to trend. And I answer a lot of questions in the room. We have a lot of folks in the room that ask questions. They throw out tickers they'd like to look at. We look at those. We discuss the good, the bad, and the ugly of those particular tickers. All right, so in this options room and the alert service, the strategies I use are obviously going to be the same. I'm finding these stocks. We're going to do straight calls or straight puts. This is the most common thing we do, using calls and puts. Now, keep in mind, if a high probability trade is a good setup and I'm taking a straight call or a straight put, which calls for long, puts for shorts, there's no reason why you can't also trade the stock. You can go long the stock or you can go short the stock if you want to just trade stock and not trade options, because they'll easily qualify for that. You're just going to be trading stock as opposed to options. I trade options because of the leverage I want to get from those. Another strategy we use debit spreads. We do debit spreads, and we use weekly options expiration on these. This is a little unusual. A lot of people use debit spreads if they'll go up 2, 3, 4 weeks. We do these by using a weekly expiration. So if we go in on a Wednesday, we'll buy a call and sell a higher price call to create a debit spread that's going to expire that Friday. And the analysis I've done over all my trades over the years and years, I've found that the debit spread using weekly expirations end up with a much better ROI than if you're out further into the future, and they also produce the profits much more quickly. Another strategy we use is what's called time spreads over earnings. These are calendar spreads. We do these to capture volatility crush. This is a non-directional trade. We're looking for the earnings to come out. We don't care which way the trade moves. We just want it to move inside of what the expected range is. So if they're expecting a 5% rate move in the stock, we want it to stay less than 5 to the upside, less than 5 to the downside. And how we make money in that is we capture the volatility crush. We'll talk about this volatility crush with options. The stocks that have earnings, the option premiums are jacked up by the market makers much, much higher than normal before the earnings come out, because they don't know what the earnings are going to be and they don't know which way the stock's going to go. So they protect themselves by jacking up the premium. And our job here is to basically harvest that volatility crush when the earnings comes out. I also have a strategy called the weekly ATM strategy. This basically is a methodology that we use to capture premium week after week after week by selling puts that we have, and we have a longer dated long put out there to protect us to the downside. So we have a very minimal risk, and we can harvest premium every week basically off of time decay. And then we also do credit spreads to capture premium over 3 weeks. You're probably familiar with regular credit spreads. We do a lot of credit spreads on stocks. That actually has a long put and a short put that expire at the same date. Slightly different than this weekly ATM, but again, this is a bullish strategy, and this one is also a bullish strategy. The time spreads are non-directional strategy. And then we have a thing called the SPY super system. We just call these out in the room. I don't alert on these. These are trades that we're going to either trade the SPY or the Qs, long or short, and we do it based on our criteria. We know the institutions are in there, we're at a nice support level, and we also know that the market internals are in our favor. And this doesn't happen a lot, but when they do line up, it's a very, very high probability trade. Okay, so those are the strategies we use in the room. The alert service is basically designed for day trades and short-term swing trades. We're not doing investments here. We're trading either intraday trades, or we're doing overnights and maybe out to as much as 2 weeks. It depends on the trade, but this is what it's designed for. It's not for having a trade that's going to last 2 months, 3 months, 4 months. We don't do that. It's designed for traders who can't or don't want to watch the market all day. That is a lot of people. We're going to send out real-time alerts on only the highest probability trade setups. When we find them in the room, I'll send an alert out right then. Takes less than a minute to get to your phone normally, and it's going to tell you we're taking this trade, and it becomes one of the alerts that goes out. And how do we find these highest probability trade setups? I'm going to get into that in a little detail, but we identify institutional involvement that we talked about. Are the institutions in this trade right now? Are the market internals bullish as well? Market internals are different than institutional involvement. This is telling you, are there way more stocks moving up on up volume and upticks than moving down on down volume and down ticks? If that's the case, then the market internals would be bullish, and that helps with having a higher probability trade. And then we go into some more deep dive on technical analysis to identify the best of the best stocks that we have. All right, now this is just a P&L of the last 90 days. It's just to kind of show what the P&L looks like generally. I'll go over some of the results so you can see where this comes from. All right, so I want to cover, before I get into the options, I want to go ahead and cover our results since the last quarter of last year and up through the first quarter of this year. And the reason I do this is obviously I want you to see how the service and how the profits are coming in, but I also want you to see individually what you can expect on the trades that you take, whether you're in the room or whether you're on the alert service. This is, if you get, I'm sure you get a lot of videos and emails from people that can tell you that you can make 500, 1,000, 2,000% on the trade. It's easy, no problem. Well, it's not easy, it's not no problem, and you can't do it. You can't do it consistently enough to be a consistently profitable trader. We're taking anywhere from usually 5, 10, 15%. Normally around 20 to 40 to 50% is what we take on the trades, and we do this trade after trade after trade. So these are the September trades that we took. You can see we had losses. I emphasize we take losses like everybody does. If you find a service that doesn't have any losses, I don't think I would take a chance on that, because everybody has losses. But you can see we had some nice wins here. We had a nice 108% win in STX back in September, FISA 22. But you can see what they were at, 31 on Oracle, and 5% small one on Square, AI 43%, and again, Square at 23%. So again, McDonald's 35%. So this is what you can expect. This was our September results. We did 25 wins and 2 losses. That's a 92% win rate, which is about as high as I can get. I mean, I don't know that I've ever done a month higher than 92%. Usually it's slightly less than that, as you'll see. But what I use here is I assume that if you invest $2,000 in each trade, and this is just an arbitrary number, obviously, but I want to have some way to gauge how we're doing trade to trade, month to month, quarter to quarter, et cetera. But if you invested $2,000 in each trade, it created a profit of $77.88 in the month of September, which is pretty nice. And our September, I do mention our September trading results were really outstanding, and they were achieved in a very difficult market. It was very, very difficult to trade in September. We were very specific about the trades we took, and we had some pretty good success there. In October, we did 24 wins and 4 losses, 86% win rate. That's pretty normal. Normally between 85 and 90 is where we sit at the end of each month. Again, 2,000 invested in each trade here, created 44.80. Again, you can see we had some losses, but you can see the percentages on the winning trades just keep repeating, 20, 25, 30, 35, 40%. Yeah, RH 43% here. This was a time spread here of 28%. We did lose on GNRC on a time spread. So that kind of shows you what the October results were. Here's our November results of last year. Mark's asking me, why aren't I presenting results between 10/23 and 2/24? I haven't got there yet. I'm coming. Okay, so here's November. This was, again, and again, you can see the results here are pretty consistent. I try to be really transparent on this stuff. These are the losses we had. These are the wins we had. We had a 21 wins and 4 losses, 84% win rate. And that was pretty good. I mean, it's a good month. We netted 5160. You know, the profits that you take each month is a lot of it's dependent upon what the market's been doing. Because if the market is choppy and just very difficult to trade, you can't stay in the trades as long. So your profitability is going to be knocked down a little bit. So sometimes I'll have a lower win rate and a higher profit. And sometimes I'll have a higher win rate and a lower profit. It depends on the market. But again, you can see here what we take. And again, you can see the percentages, they don't change an awful lot. I mean, they're staying in the 20, 30, 40% range generally. And this was a December, very slow month for us. We didn't make a lot of trades. Holidays, we get Christmas, you get New Year's. It was very choppy, very difficult trading. We had 14 wins and 2 losses, 87.5% win rate, 2,000 netted, 2,000 invested, netted 31.15. That's pretty good on only 16 trades. So, but this was December of this past year. And again, but then you notice the percentages not changing much here. January, this January was a really good month. We had again 20 wins and 2 losses, so about 90% win rate, pretty nice. These are some of the wins we had. We had all wins in January until we went into February, and then some of the trades I opened in January ended up being losers. So I had a couple of losses that weren't reflected until in February, but I put them in January because that's where we opened them. That's how this Gilead one is popped in here. But again, 22,000 invested, netting 75.05. So again, January, pretty good month. February was a tremendous month. This was really a really good month. This is a month I actually started splitting out the alerted trades and the in-room trades, because we take trades in the room we don't send alerts out on. And there's a few reasons for that. One is if I'm taking a trade and I don't expect to be in it for more than a half an hour, 45 minutes, I don't think it's fair to send it out to the alert service because they may not have time to deal with it. And if I take a trade like at after 3:30 or 20 minutes of 4 in the afternoon, just before market close, again, I don't think it's fair to send it out to the alert service because it's not enough time for them to trade it. And we also do some trades in there that are more of experimental type that we trade that I don't send out an alert service. So this was our February trades, 24 wins, 2 losses, a 92% win rate, but 2,000 invested in each trade, netted 11,745. This is a pretty big month for us. And again, the market was really good in February. I think a lot of people who trade had good Februarys and think now that they've got this all solved, but that's not the case. But this is what February looked like. And again, on the alerted trades, we had 20 wins and 2 losses. So we had 4 more trades in the room than we did in the alert service. But they had 2,000 invested in each trade at netted 69.30. So pretty good. I mean, that's pretty good on the alert service. And I'm trying to break that out now. People wanted to know what's the alert compared to the room. And they also asked me why I don't show first of last year. We had a really good year in 2023, but when I had the results up here from March, April, and May and stuff, I get questions as why don't you put current stuff up there? And I don't want to list everything for the last 2 years, so it's too much. All right, and I haven't done March individually yet, but the first quarter, this is first quarter. We actually still have some trades open in March. But this is our first quarter trading results for 2024. We had 65 wins in the room, 65 wins, 11 losses, 86% win rate, 18,763 is our total profit if you took 2,000 in each of those trades. Pretty nice, a little over 6,000 a month. And I'm basing this on 2,000 a trade. And the alert service of 41 wins and 6 losses, 87% win rate, 12,224. Not bad, but these are the results we've got so far. These will probably actually go up a little bit because I've got still got 3 trades open from March that haven't closed yet that are likely to be profitable. And if we look at 2023, this is the whole year of 2023 as far as the results. We had investing $2,000 in each trade, taken to the Compass Options room, produced a profit of $60,208. So I'm assuming here, if you use an account of $50,000 on each trade, you'd be using 4% of the account balance when you started the year. It obviously was going to get lower as the account grew, and it produced 120% return on the initial 50,000. And we're right on a target to do that again this year. As again, we're up over 18,000 in 3 months. That's if you extrapolate that out, it's about 72,000. So we grew the account to about 110,000, and at the end of the year, $2,000 trade was less than 2% of the final account balance. So I just kind of wanted to give you the recap of what we did. Mike, you're asking, do all the buys come near the open? You're in a different time zone. No, very few of the trades. The only things I do at the open is close trades out usually. I usually don't take any trades until about 10:15 or later, because I wait to see what the market's going to do. Now, if we've got trades on from previous days and I get movement in that stock, like in the pre-market gap up or something like that, then I'll take them off. But if that's the case, you're already going to have a sell target. Most likely, I'll have already alerted out with a sell target, and that should be working for you even if you're not in the market. Okay, so yeah, I don't take any trades early in the day. I'm not chasing anything. I'm trying to be very, very methodical about this. All right, so let's move forward here. Again, this is on the alert service, what you're going to get, how the alert's going to come out. Obviously, we trade the best, skip the rest. I like to keep emphasizing that. Every alert trade is going to, every alert that we send out, it's going to include obviously the stock symbol, the option strike price, the option expiration date, and the price to pay for the option. And that may be, $1 to $1.05 or something like that. It may not be an exact number, but it's going to give you a small range, usually a pretty small range. If the stock takes off before we can put the trade on, I don't usually chase it. I would just put an order in to buy it at what the original alerted price was. And a lot of times, most of the time, the stock will come back, touch that level again, and you'll get filled later on. And again, that's the what you get on the alert service. And usually I don't send a sell order out when I send the alert out. I usually wait until I look at the price action. I want to see what the stock's doing. And then I'll send another alert out with what your sell price should be, your profit target. And you can put that in there, and you just put it in as good till cancel. So if we're in the trade for 2-3 days, it'll always be working for you, even if you're not watching the stock. Okay. Now I do want to go over how we get these results that we get. I like to show the results, and I want to show you what methodology we use to do that, and how you can do that as well. How to achieve these results? Okay, as I've said multiple times, we're able to identify when the institutions are driving a trade and when the market internals are heavily bullish or bearish. This is really important. So we only take trades when both of these are in our favor. This is not true because when the market internals are neutral, if they're not bearish, not bullish, then I'll be focused on stocks when the institutions are in them. If the institutions are in them, then I'll take the trade as long as the market internals aren't against me. Okay, so that's how we do this. And another question: do you indicate where the stop loss should be? My stop loss is always going to be based on my technicals. I don't tell you where the stop loss is going to be. I will take the trade off if it goes against us. I'll send an alert out and tell you to exit the trade, take the loss, and move on. But I wait, because all my trades, first of all, as I've mentioned before, I'm focused on the daily chart. The daily chart is my key. If a stock stays above support on the daily chart, depending upon how much time there is to expiration, then I'm going to stay in the trade as long as it's bullish. If it gets too close to expiration, I may just take it off for loss and maybe roll it out to a later date. But I don't say, okay, here's the trade, take it off if the price gets to this level, or if the options get to this level. I don't do that. A lot of people will trade and they'll say, okay, I'm not going to take more than a 15% loss on my trade. But you see, that is not valid. You should only be exiting a trade when the criteria that gets you into the trade, the technical criteria of the stock setup, fails. You don't want to be out just because you're down 15%. Because listen, I've done this a long time, and many times I used to do that, and I'd get panicked, I'd get out of the trade, and I'd come back 2 days later, and I basically gave up 40% profits because of that. All right. Let's see. What trading platform am I using? I use the ThinkorSwim for the Compass system. I don't trade on ThinkorSwim. One of the key things here is if you're using the Compass system, you do not have to trade on the platform that you've got Compass working on. Compass will run on ThinkorSwim or it'll run on Ninja. But I trade through a company called Tradier using what's called TradeHawk as a front end to Tradier because the commissions are so low. But my Compass system is on ThinkorSwim, and it doesn't really matter who you're using as a broker. Can I share what's on my daily chart? Yeah, I'll do that. I'll do that, Ken. You hang on to the losers far too long. Well, you know, that's a big problem. But the thing is, what a lot of people do is they'll say, I'm hanging on to losers too long. So they'll start taking trades off much more quickly when they're slightly in the red. And then they end up giving up a lot of winning trades. I mean, I have losers, as you can see. A lot of the losers, I'll take some, and they're fairly large. Sometimes it's 50, 60, 70% because I'm giving them time. But what I've found over the history of my trading is if I take them off sooner, I end up giving up a lot more gains than protecting a lot of losses. In other words, by taking those losses, I'm actually hurting my P&L overall. Does the Compass system work on wealth charts? No, it only works on Ninja and ThinkorSwim. It loads on both of those, not on wealth charts. And I'm familiar with wealth charts. All right, so this is how we find the very highest probability trades. This is how we get these results we're getting. ThinkorSwim is not allowed in Canada. Well, you can do. I think you can use Ninja up there to trade off of. I think it does. And you can ask. Listen, that's a good question for Rory. Why don't you pose that one to Rory and see if they have an answer? Because we have a lot of Canadian customers. So, okay, so that's how we retrieve these results. Now, what I want to kind of go over is the Compass system, how it identifies when institutions are creating a trend. How do we know this? Well, we use what's called a triple screen assessment. Some people call this fractals. Some people call this, it's basically a multi-time frame comparison of these three things. We're looking at momentum, we're looking at trend, and we're looking at money flow. Now, we're looking at momentum over multiple time frames. We're looking at trend over multiple time frames. We're looking at money flow over multiple time frames. When these all line up, let's say they all line up bullish, for example, your 5-minute, your 15-minute, your 45-minute, all of these are bullish on momentum. They're all bullish on trend. They're all bullish on money flow. Just about the only way that can occur is if the institutions are in there right then, if it's bullish, buying, and if it's bearish, selling. All three of these lined up across multiple time frames gives you a huge high probability of that information giving you the fact that institutions are in there right now. This is, I just kind of wanted to show, we're going to go over a bunch of charts after we get through options, but this is what the Compass system looks like on ThinkorSwim. This is a trade we took, and I just show this as an example. These are the indicators that we use here. This is multi-time frame trend. This is multi-time frame momentum. This is current time frame momentum, and this is the derivative of money flow right here. And you can see they were all green. This was a Tesla trade we took. You can see how nicely these lined up. This actually uses a Fibonacci. This is using Fibonacci because I have a video where I show how to use Fibonacci candles. But this is where we took the trade, and you can see this little thin green line here is a 15 EMA, and that is the support level. This pink arrow is the Compass system creates. This is called the pop out of the box, or a pop signal, which is telling you that the stock is breaking out of compression, which you can see it is right here. So this is where we took the trade. We rode this trade all the way up until we started getting wicks and tails here, and we get out. But this basically, I just wanted to show you what the Compass system does. I'll show you more charts with the Compass system and some of the other indicators that we put that get created on here. All right. So let's talk about options. All right. Let me take a quick drink of water here because I'm going to get into options. And I'm not sure what everybody's experience is. Some of this stuff may be too basic for if you've been trading options a while, but I'll get into more in depth. Okay, first thing we're going to show here is an option chain. If you have not seen an option chain, if you trade options, you know what this is. This is basically what an option chain looks like in every platform you use. You've got what I call a strike price here in the middle. This is your strike price. This is your calls on this side, on the left. Puts are on the right. Always on the calls are always on the left. Puts are always on the right. These would be the different strikes, and over here is the information related to that particular strike. Now on here, if we look, this is Bristol Myers from a couple of weeks ago, but up here is your expiration dates. 15th, see, it's every week on Bristol Myers. So you can just click on that and it will go to the expiration week that you want. In here, you've got what's called the bid and the ask. That's pretty obvious. I mean, this stock is being bid at 355 and asking 545. Big spread there on that particular strike price. Down here on 54, which is basically approximately where the place that the stock was trading at the time. You see, it was 53.79. So this is what would be basically considered pretty close to an at the money. You've got bid 61, ask 66, so just a 5-cent spread. Now, one of the things that's in here that you need to be aware of is this thing called delta. Okay, and we're going to go over what the delta is, but this is kind of important. When I take a long call, I'm always looking for deltas of about 65 to 75. All right, and a delta, as we'll cover, basically is a indication of how much the price in the option will move versus how much the stock price is moving. So if you've got a delta of 71 on an option that you take, if the stock moves $1, your option price is going to go up about 70 cents. All right, so this is what the option chains look like. This is what you'll be working with when you're doing puts and calls. This is the call side over here. You can see exactly the same thing. You see the $54 call here was 79 by 83, and the put was 61 by 66, at $54. So that's what you've got here. Now I have one other screen here, and again, these are all your expiration dates up here. Same information, but what I put in here is everything else is the same, but over here is what's called OI and volume. This is open interest and the volume. Open interest is how many option contracts were outstanding at the beginning of the day. So in this particular case, there was 11,867 call options that were outstanding at $50, $50 calls for this particular date on Bristol Myers. All right, the number in blue here, 617, that's the number of contracts traded today so far. So we had 617 calls that have gone off, and there was 11,867 to start. Now that 617 is not included in this 11,867. At the end of the day, all the trades that have come and gone will end up with a new open interest. But open interest, if it's high like that, it tells you that you're not going to have any trouble to get into the option or out of the option because there's plenty of volume out there. So that's what you look at on the open interest and volume. And you can in any platform you can display lots and lots of different information, but I just wanted to show you how you find the open interest and the volume for the day. So that's an option platform. If you haven't traded, you'll get used to trading these. There's lots of videos from ThinkorSwim on how to trade these, but this is what they look like. All right, so what we're going to talk about here, and I mean I can't go through everything on options because it would take way too long, but I do want to cover some fairly basic stuff here. So we're going to talk about what are options. We're going to talk about what makes up the option premium. We're going to talk about intrinsic versus extrinsic value. This is important. We're going to cover the Greeks a little bit, not a lot. We'll talk about strike price and expiration dates, volume and open interest that we just talked about, and primary option trades, the primary ones I use. We're going to talk about which options strategies are bullish, which are bearish, which ones are neutral. There can be a lot of neutral strategies using options. And then we talk about some of the setups. All right, and it's important to understand that options, a lot of people think trading options is just like trading a stock. You know, I can take a stock, I can take an option, it's the same thing. It's not. It's not. It's completely, it's totally different. there are a lot more nuances to trading options. All right, so we're going to talk about what are options. We'll talk about calls and puts, rights and obligations. Let me see if I got this here. Yeah, okay. There's when you buy an option, when you buy a stock, put, or a call, that technically that gives you the right to buy or sell that stock at the strike price that you bought it at. So you buy a $100 call in Microsoft, you have got the right to buy Microsoft at $100 a share, no matter what the stock price is when you want to exercise that. So when you go long a call or long a put, you have the right to buy the stock, but not the obligation. You don't have to. And most people just buy the option and they sell it when it goes in their favor, or they buy it back if it goes against them, or they'll sell it when it goes against them and lose some money on it or make some money on it. But you don't have any obligation when you're going long calls. Now, when you're selling a call or selling a put, and I would tell you right now, don't ever sell calls if you don't have a stock or another option to offset that. Never do any naked calls. But if you're selling puts, for example, what happens is you have the obligation. When you're selling something, you have the obligation to supply that stock at that strike price to the person who bought that from you. So the puts, the sells, when you're selling a put or selling a call, with that comes the obligation to sell that stock or give that stock to somebody at that price, which means you'd have to buy the stock to sell it to them. So that's the difference between being long calls and being short calls, or being long puts and being short puts. It's the rights and obligations. The buying gives you the right, but not the obligation. Selling obligates you to supplying that if it gets exercised or if it gets assigned to you. Usually you're going to take the trade-off before that happens. All right, so obviously you can buy or sell. When you're buying a call or a put, you're going to be, it's called being long a call or long a put. If you're going long a call, you're expecting the stock to go up. If you're buying a put, you're expecting the stock to go down. That's pretty simple. When you're selling, it's called being short a call or short a put. Okay. So buying a call is long, buying a call is bullish, selling a call is bearish. Buying a put is bearish, and selling a put is bullish. Right. So this is you want to understand what you're looking at when you buy a call, you're expecting the stock to go up. When you buy a put, you're expecting it to go down. Pretty basic, actually. Okay. So the option premium price that we just looked in there in Bristol Myers, we saw the 61 bid, 66S. What makes up the option premium price? Well, an option can be three things. They can be at the money. So if you've got a $100 price on a stock and you're buying a $100 call, that's at the money. Okay. It can be in the money. So if you've got a $100 stock price and you buy a $95 call, then it's $5 in the money because the stock is higher than the price that you paid for it. And then there are out of the money options. So that would be if the stock price was 100 and you bought a $105 call, you're expecting the stock to move up to reach that price eventually. But right now it's out of the money. It's completely out of the money. So what makes up the premium price? Well, part of it is the stock price. So let's take the $100 example. If it's $100 and you buy a $100 call, it's at the money. The stock price is, you don't have any benefit to the stock price at that point because it's exactly even. You're not getting any intrinsic value. Then you have what's called intrinsic value. If you buy a $95 call and the stock is 100, then you've got $5 worth of intrinsic value because the stock is higher than your strike price. So your call, the $95 call, is going to be worth at least $5 because the stock's trading at 100. That's the intrinsic value. Another thing that goes into the price of the premium is implied volatility. And this is how much the market makers expect that stock to move up or down. And they increase the premium on that stock by what they think the implied volatility would be. So stocks that move around a lot, that move up and down fast, especially like biotechs and things like that, they have a lot of implied volatility built into the premium. So they're expensive to buy those calls or buy those puts. And the last thing is time decay. And time decay is the time between the current time you bought the stock. If you buy a $100 call on Microsoft that expires 4 weeks from now, you obviously want this thing to move, but it's got to move within that 4-week period. As the time gets closer and closer to your expiration date, the decay or the amount that premium goes down on your option is going to accelerate. So that's all the things that are built into the option premium price when you buy it. All right, so that's kind of important. Now, let's talk about intrinsic versus extrinsic value. This is kind of important to know. In a case like this, if your option price is in the money, that's intrinsic value. So if we have a $50 option on a stock trading at 55, right? So we have a $50 call and the stock's trading at 55. It has an intrinsic value of $5. Obviously, this $50 call is going to be worth at least $5 because the stock's trading at 55. The extrinsic value is the option value minus the intrinsic value. So let's say that this stock right here that you bought a $50 call on, and the stock's trading at 55. Let's say that stock is trading at $6. All right, the option is trading at $6. So that you have an extra dollar worth of premium that you're paying for outside of the intrinsic value. In other words, you have $1 at $6. It's $1 higher than the $5 intrinsic value. That's extrinsic value. The extrinsic value is what is going to go down based on time decay and any implied volatility changes. That's what gets impacted the most. The intrinsic value is going to be impacted by the stock price movement, but the extrinsic value is going to be impacted by the implied volatility changes and the amount of time decay that's in there. All right, so that's what's important. And the way I highlight this is we have this $55 stock. So let's say you bought a $60 call, right? You bought a $60 call. So you don't have any intrinsic value because the stock is trading at $55, right? So zero extrinsic value. All of the premium is made up of implied volatility and time decay. So if you bought a $60 call, and it's not going to cost a lot. Let's say it costs $1.50 for a $60 call, and the stock's trading at $55. That $1.50 that you're paying for that is all extrinsic value, which means unless the stock moves up to 55 or to 60, that premium on that option is going to go down in value based on the time decay as it gets close to expiration and any implied volatility. If the implied volatility drops, the option price is going to drop. So that's why doing out of the money, I never do out of the money calls and puts because of the fact that I'm just letting the market kill me here. I'm letting time and implied volatility destroy me without any kind of intrinsic value. Right, and also important is the volume of options traded. It's a strike price and expiration date as well. And we talked about that. The open interest is going to allow you to have some flexibility in the trade. You'll be able to get out much more quickly if there's a lot of open interest. If there's just a little open interest, it can be more difficult to get out of a trade. All right, so this is kind of a lot of people, sometimes it's a little bit hard to understand, but it's really basically how much of my premium that I'm paying for the option is based on the actual stock price itself. That's intrinsic value. Okay, now we'll cover the Greeks here just briefly. These are basically the three that it's probably important to know about. Delta, and we touched on delta. This is how much the option price moves in relation to the stock price move. So if you've got a stock moves $1, a delta of 50 means the option is going to move 50 cents. A delta of 70 means the option is going to move 70 cents. A delta of 20, which is an out of the money option, is going to move about 20 cents. That's what delta tells you. And obviously, as your stock price moves up, if you're in a call, then your delta is going to get higher and higher because it's going to move more and more with the stock price as it gets close, gets more in the money. Theta, which is time decay, this is the decrease in the value of an option price as expiration date approaches. Now, the time decay or the theta, it's not spread evenly over a period of time. If you look at the way time decay occurs, if you've got like an option that's out 4 weeks, the time decay in the first couple of weeks is really pretty slow. The increase in the time decay is really just goes very, very slowly up. As you get into a week before, it goes up faster. And as you get into the last couple of days before the expiration, the time decay really accelerates and is really going to knock the price of that option down quite a bit if you're not deep in the money. Okay? And gamma, this is kind of an interesting one. This is the rate of change in delta. How fast is the delta changing? In other words, if the delta goes from 50 to 60, and how fast is that occurring? That's gamma. And this can happen when a stock is moving up really, really quickly. If you have a stock that takes off and just starts ripping up green candle after green candle after green candle, then the gamma is going to go much higher, because what's happening is the implied volatility is going up very, very quickly. And so the high gamma means the option price can change dramatically with only a small change in the price of the stock. That's why you'll see options that on a stock that comes out that's moving up really quickly, you'll actually see the option price move up faster than the strike price. That's because of gamma. Okay, so the primary option strategies, and the ones that I use most, obviously long calls and long puts. Put credit spread or call credit spread. This is basically just bringing in premium. Put debit spread or call debit spread. This is anything that's a debit we're paying for. This is basically a way to limit your exposure or your risk by cutting down on the amount of premium that you're paying for the spread. And then with calendar spreads, which, as I mentioned before, is time spreads that we do only over earnings. These are non-directional, these calendar spreads. And then there's things that I don't do, condors, which I don't do, butterflies I do some, and strangles and straddles. Strangles and straddles are also non-directional, and condos can be constructed to be non-directional. But so these are the primary option strategies. Now, if you look at the bullish and neutral option strategies here, what we've got for bullish option strategies, obviously long calls, short puts. You go and just buy a call, sell a put, do a put credit spread or a call debit spread. These are bullish option strategies. The bearish option strategies are just the opposite. Your short calls, your long puts, call credit spreads are bearish, and put debit spreads are bearish. So you can see the opposite of the bullish one. So those are the strategies for bullish and bearish. These are your neutral strategies: condors, straddles, strangles, and time spreads. These are all neutral strategies. In other words, you don't care which way the stock moves. In some cases, straddles and strangles, you want it to move a lot. In condors, you don't want it to move a lot. And time spreads, you don't really want it to move a lot. So those are the bullish and bearish and neutral option strategies that I follow. And that's just so you can identify, you want to do some options, you want to do a strategy. Am I bullish or am I bearish? Then you can know which ones to take. Okay, let me see if we have any questions here. Let's see. Yeah, Rory's answering some questions there about some folks in Canada actually use interactive brokers, and then they put the software in Ninja, because Ninja doesn't cost anything. But you can just put the Compass system on that and then trade off or interactive. Just depends on who you're using for brokerage house. All right, so these are basic option strategy setups here. And if you've been trading options, you probably know these things. But put credit spreads, you sell a put and buy a put at a lower strike price, and you receive a credit. That's why it's called a credit spread. A call credit spread, you sell a call and buy a call at a higher strike, receive a credit. Bearish strategy, bullish strategy. A put debit spread, you buy a put and sell a put at a lower strike price for a debit. All right, that's bearish. Call debit spread, buy a call and sell a call at a higher strike price for a debit. Bullish. All right, so those are your spreads, credit spreads. Calendar spread is like a time spread that we use. We sell a put or a call at or near expiration date, basically the current expiration date, and buy a call or put with a later expiration date for a debit. For the time spread, which is basically a variation of a calendar spread, it's a specific calendar spread. We're selling current week's expiration and buying next week's expiration. So we're just doing a week apart. So we're going to sell the current week's expiration, call a put, and buy next week's expiration, call a put, using the same strike price. Okay. And a strangle, basically you buy a call and buy a put one strike or more away from the money using same expiration date. So if you had a strangle if you had a stock trading at 100, a strangle would be buying a $101 call, buying a $99 put. You just basically strangled the at the money price, one strike higher, one strike lower. A straddle is buying a call and buying a put for the same strike price. So a straddle on a $100 stock would be buying a $100 call and buying a $100 put. You're basically looking for a move that's going to exceed the total premium that you're paying for both of the put and call together. All right, the same thing on the strangle. But those are the option strategy setups and the trades you can use doing those. And choosing the best option. Okay, this is kind of important. What you're looking for here is, and this is the normal way that I trade, the strike price, expiration date, and delta. All right, so if I've got a stock, and let's say the stock is trading at 100, I'm going to take an in-the-money call. So my in-the-money call is going to be somewhere in the neighborhood of $94, $95, $96. I'm going to be in the money by $3, $4, $5. And that means the delta is going to be around 65 to 75. So that's how I find the strike I want. The expiration date, I have to look at a few different things. Even if I'm taking a day trade, I'm going to go out at least a couple of weeks in expiration date. I don't want to have time decay hurt my trade too much. So I'm going to go out usually 3 weeks to 4 weeks. Now, an interesting thing here is if you have earnings coming up, you never want to hold trades over earnings because you don't know what's going to happen, and they're jacking the price up on the premiums. But the fact that they jack up the price on the premiums because our earnings are coming can help you sometimes when you're going long a stock or short a stock. Because if you take an expiration date that occurs after earnings, if you take the date that's after earnings, then you're going to pay more for the option, of course, because they've jacked up the premium. But it's also going to decay much less because there's so much premium in there based on the expected earnings move. So you're going to be able to protect yourself a little bit to the downside, and you'll still make the same money to the upside, but it's going to cost you more for the original premium on the call or the put. But you've got to get out before earnings. You've got to get out before earnings. But the whole key here is it's allowing you to take an option that's not going to decay as much as another option would that expired before earnings. But just make sure you're out of the trade in time. So generally, 3, 4 weeks, sometimes 5 weeks, I'll go out on the expiration date. I have to look at several different things before I do that. All right, so that covers options. Let me see if we have any questions on this. If the stand, how it works. I'm not sure I understand what you mean, Asher. You're talking about, was he talking about what Rory told you about being able to put Compass on Ninja and then trading off Interactive Brokers? The key here is you can put Compass on Ninja or ThinkorSwim, but you don't have to trade off of either one of them. You can trade off of TradeStation, or you can trade off of Interactive Brokers, you can trade off of any platform that you want. You're just using the Compass system to let you know whether the trade you're interested in taking is actually having institutional buying or selling on it. So that's and again, if you have detailed questions on that, Basher, give Rory a call. He can go over that with you more specifically. All right, so it's about an hour into this. I want to get moving here. I don't want to take up your whole afternoon. So that was the options. I try to present it as best I can. Some of it's a little confusing sometimes, but I hope that helped a little bit. All right, so these are some of the trades we took. Now this way I'm going to be able to show you some of the trades we took and why the Compass system told us to take them. This was a trade in Shake Shack. We were in the trade for 2 days, made 26%. You can see here that everything was green right here. And what we were looking for, this is a daily chart. Now, what I was looking for is I was looking for some sort of a break to the upside here. You see how it's compressing here? This is after earnings. It gapped up, so we had a nice bullish catalyst. We bought it right here as it came off of this little white line here and rode this up. And this pink line, by the way, is the VWAP. I do not use that on daily charts, only 5-minute charts. So we bought it here and we rode it up, and we were in this for 2 days and made 26%. And you can see I was confident that the institutions were buying this. All right, here's another one. This was Workday. So it's a little bit more complicated on workday, and this arrow's in the wrong, that's in the right spot. We were in this trade for 5 days. We were in this for quite a long time. Now, it's important to remember, here's the long-term trend was bullish. We had, when we get into it, this actually arrow was actually over here. The multi-time frame momentum went blue, which is bullish, and then it went back to yellow. But see how it's switching back and forth. But we were pretty confident because the current time frame was staying green all the way across, and the money flow was green, and the trend was green. So we took it here, and the reason we did was you can see this shaded area, that's a dynamic compression zone. The Compass system develops that dynamic compression zone. We bought the stock right here as it broke out of that, and then we wrote it up for 5 days, right up here, and get out of that. All right, so again, nice 30% profit on that. This was GCT. This was a nice breakout here. Again, see how everything's green here? See the compression here? See the dynamic compression zone? We broke out of it here. We took it right here, and we took it here, and we're in it just a 2-day trade. We get here, we get out here. We were out for 26% on GCT. It was still bullish, you can see, but it was the price action was getting pretty ragged. MDT, this was a good one here. This is another daily chart. You see how this went yellow to blue. We took it here when everything else was green. It went to blue. It was breaking over this 15 EMA rate. This is the support level, the 15 EMA of an EMA. This is basically a exponential moving average. It's kind of skewed so that it doesn't jump around as much. And we bought it here, and we took it out here. 25% profit on that trade. Vertex, 3 days. This was 30%. This was a nice one as well. Everything green. We bought it here on this pop up. We actually get in this day on this candle right here during the day, and then we get out right here as it kind of topped out, putting in kind of some wicks on top of the candlesticks. 30% profit in 3 days. This was a nice overnight trade that we took in McDonald's. We get in for 8:30 one afternoon, out the next morning at 11:30. $3 a contract, 37% gain. It was pretty nice. You can see we get in right here on this break over this dynamic compression. Everything green. You see the institutions were buying the heck out of this thing, and up it goes. So we know. And you remember one thing: when the institutions are buying, it doesn't mean the price is going to go up right then. It means they're in there buying, which means eventually it's gonna react. This was crowd. This was another nice 20% gain. And again, we had some switching colors, so we took it right here on blue, went back to yellow, so we had to watch it, but it was still bullish to us, and we stayed in this thing and took a 20% profit on that. So that worked out nicely. Amazon, 32% profit. This is a 5-minute chart. 5-minute chart. We were in it for 45 minutes. Get in right here as the stock had a pop out of the box signal right here and came off the 15 EMA. So we bought this. We're in for 45 minutes. We get out right up here and follow that. Once again, you get enough. We had a 32% profit in an intraday trade. You have to make a judgment, but I decided it was worth taking the profits right then as opposed to holding it further. Depends on what the market's doing too. This was a bearish trade, so you can see we do bearish trades. You can see the compression here. See the institutions. We can see the institutions are selling the heck out of this stock. They're all selling. Stock's moving sideways. We get a pop out of the box symbol right here coming down. That's a break of compression. We took it right here. We were in this for 1 hour, and we took 20% in 1 hour on this ENPH. So nice, and everything's still very bearish. Verizon, this was one I always like to talk about because Verizon, the options are really cheap in Verizon. We actually got in an in the money put on Verizon for 45 cents on this trade. 45 cents. This is a 5-minute chart. See the pop out of the box symbol? We took it here. We rode this thing down for 1 hour, and that 45 cents, which is $45 a contract. So 10 contracts would have cost $450. We get out at 67 cents, so $670 out of that. So about a $220 profit in 1 hour on that run. That was actually, I'm sorry, here it is, rising. It's 50% profit in 1 hour. We get out right here. We get in right here as the pop out of the box symbol went below the VWAP, and we wrote it down for an hour. And this is the one that went from 45 to 67. That's a really nice profit. It's 50% in an hour. And this was a SPY. This is one of the super system setups that we talked about. This was the institutions were in here selling. You can see all the red. We had a pop out of the box signal, so that lined up. And the market internals also lined up at this time for this trade. So we took a quick trade in the SPY. Again, it's a 5-minute chart, so this is not a long trade. We just wrote it down here and then get out. But it worked out pretty nicely. And again, you can see the institutions were selling it. This was a test, so this was a nice overnight trade. Sometimes we'll take these overnight based on the daily chart. We looked at the 5-minute chart. I mean, here's the 5-minute chart. Here's a pop out of the box signal going below the VWAP right at the end of the day. So we took some Tesla puts at the end of the day here, and it opened. It went from 120 to 112, gap down, and we rode this thing down. And those puts exploded. We paid. I think we paid. We made about $7 a contract on those puts on that move down right there. All right. So again, let's just recap what we use in the options room and the alert service. Straight calls and puts. This is mostly what we do. Debit spreads, time spreads over earnings, weekly ATM to capture premium, and credit spreads to capture premium. So we've got a pretty nice mix of strategies, and this allows us to take the strategy that is best to use for the market conditions at that time. There are certain markets that are choppy, they're not going anywhere. You're really better to do like credit spreads at that point in time. Take credit spreads because you don't expect the stock necessarily to go up and make the call really profitable. So you don't care that it's just moving sideways. If it's moved sideways, you take credit spreads and capture the premium. If it moves up, fine. You're still capturing the premium. We just finished up a couple of these credit spreads, and they produce very nicely. And you don't have to watch them all the time. You just really kind of watch them week to week. All right, so these I just want to do with the offers that we got on the particular services that we have here. And again, I want to thank everybody for being here today. The Compass Options Alert Service. This is the Options Alert Service, and we're doing 50% off. It's $7.98 for a whole year, which to me is really a good deal considering you saw that what we did last year with the options with the alert service. You can do it quarterly if you'd like for $2.96. I don't know that quarter is enough to really give it a good test, but you can. You'll also get a month of the trading room access into my room. You get access to the Discord chat. Obviously, you're going to get the alerts, but you'll get the Discord chat where we have 2 other professional traders in there every day, posting charts, talking to you, and also you get the video. I have about 25 videos on the wise way to trade options. Goes into details on just about everything we talked about today and all the strategies we take. And I will add that, by the way, in the room, I'm there every day from about 9:15. We're there market open to market close. So we're watching the chart, the market all day long. So you can come in and go out as you please. But I'm there most of obviously all the day. I do take time for lunch, but usually I'm still watching the market. This is the trading room itself. This is also 50% off, $8.49 for the room, and that comes with the alert service. So that's really a good deal if you take the room for $8.49 for a year. You can try it for a month for $148. Again, I just don't think a month is long enough to give it a good test, but that's up to everybody. And last thing is, if you do want the compass system we showed you on that can run on ThinkorSwim on Ninja. It's a 50% off full year for $12.49 and quarterly for just $5.98. And there's a lot of scans in there. I didn't show you that they come with it, and we add multiple scans. You notice multiple trade scanners. But again, you're going to get access to the room for a month. You're going to get the Discord for a month, and you're going to get access to the videos as well. So those are the three offers that we have: the alert service, the trading room, and the compass system. So in the compass system, you can get and still be in the alert service or the trading room. You can get them both, but that's up to you. So that's all in all what I use here, how I trade, and that's kind of a recap of options as best as I can do in a quick presentation. It takes a good long time. I'm trying to roll some educational information into these webinars so that it can help some people, with their education as far as trading is concerned. All right. So let's see. Anybody have any questions? No, I don't see any other questions. Let's see. Is the chat room separate? The chat room is the chat room is right here, the live trading room. This is the chat room. The Discord room is a chat room. It's not set. It comes with the Discord room comes with the options alert service or the live trading room. You get the Discord chat room. The tape is a webinar tape. It is, Freddie. There'll be you'll get a replay of it sent out to you if you registered. Yeah, you'll get it registered there. And I think in the chat box in there, yeah, Rory's got all of the 3 different offers listed out there, so you can just click on those, or you can go ahead and call Rory and put in your name and number here, and he'll follow up with you to answer any questions you might have. So listen, I very much appreciate everybody being here today. It was maybe a little bit longer than what I wanted to go, about an hour and 15. That's not too bad. And the options takes a good long time to do that. So again, thanks so much for being here. I appreciate that, and hope to see you on the alert service or in the room pretty soon. Have a great weekend. You're welcome, Ken. You're welcome, Mike. All right, thanks everybody. Just thanking a few people here. Thank you very much. Have a great weekend.